Okay, so the focus of this lecture is on moving averages. I very briefly introduced the moving average in the lecture that introduced MetaTrader 4, but I want to focus in this lecture on how we can actually use a moving average to interpret the currency market, to tell what the market is doing, and maybe even to make some decisions on what trades to take. So the reason I start with moving averages is this is the great granddaddy of all other technical indicators. Most other technical indicators you see will include a moving average in them. For instance, MACD, one of the most popular indicators, it's just a combination of different moving averages. Ichimoku Cloud, which sounds very exotic, it's a popular Japanese method of trading, also includes moving averages. Just about every indicator starts here. So this is a great building block in your tool belt of technical analysis. What I've done is I've made a few changes to my chart. I've just changed the way that the candles look. Up candles are now black, down candles are now white, and I've just done that because I find that a little bit easier on the eyes. And what we've done here is we've just added a moving average. We've gone to our navigator, added it onto the chart. In this case, it's a 200 period moving average. We're looking at 200 hours of data. And this is important. Moving averages typically should be used only with relatively large sets of data. And the reason for that is we're actually looking at the average price of a currency. And if we're not looking at a statistically significant or relatively significant amount of data, then the average is fairly useless. Just if you were to average the price of, only a few different items, if you're doing some kind of mathematical calculation, that wouldn't be as useful data as averaging the price of thousands of different items. And that might sound a little bit esoteric, but we are going to go more in depth into that in this lecture. So in general, you want to use a fairly significant average anytime we're doing analysis on what the market is doing. We're applying this to the close, which is the most common method of using the average. We are going to just keep this simple. It's just a straight average, the 200 periods, closing price, added together and divided by 200. Now, this average will update every time a new hour opens. Every time a new candle opens, it will roll forward. So we're always looking at the most recent 200 periods of data. But how can we use a moving average to actually make decisions in the Forex market? What does a moving average tell us? Well, we're looking at the average price of a currency pair, in this case the euro-dollar. And because we're looking at the average price, we can know whether or not the price is around the average, above the average, or below the average. So how does that help us? Well, generally speaking, there are three main conditions that the currency market can be in. The first is called an uptrend, and that's when prices are continually moving upward, where we're having higher highs and higher lows. So in the example that we're looking at here in the euro-dollar, an uptrend would be where the price of the euro is rising against the dollar. The second condition the market could be in is the opposite. It's a downtrend, where price is falling and we're having lower lows and lower highs. This is a great example of a downtrend where we can see over an extended period of time the price keeps falling. And the third condition the market is in is called a range or a consolidation. This is also known as trending sideways, where there's no clear definition as to if the market is going up or down. And this is a good example of a consolidation or a ranging period. The market is essentially just going sideways. The exchange rate between the euro and the dollar is not really changing very much. So by using a moving average, we can very easily and very quickly tell where price is, which is the first step in determining what market condition we're in. So, for example, if price action is very close to the moving average, then this may be an indication that the market is moving sideways. And that's just to say that the price right now, if the market is right at the moving average, then we would say that that's an average price. Of course, that's fair value for this currency. It's not above, it's not below the average, it's just average. So that means that maybe we don't have a strong indication that the price is going to go up or going to go down. We know it will move eventually, but right now it's just fair value. Whereas if the price is significantly below the average, then we could say that that's a downtrend. The market is below the average. It's been below the average for a while. It looks like it's going to continue to move below the average. It's below average. It's a downtrend. That may be a strong indication that the trend will continue. You know what they say in stock trading and other types of investing, the trend is your friend. So if you can look at your average and tell where the trend is going, then that could be helpful. And of course, the opposite of that idea is that if the market is significantly above the average, that's an uptrend. Now, of course, these are just generalizations, right? We're not always going to be accurate in our analysis using a moving average in this manner, but this can help us make decisions on what kind of trading to do, on when to make decisions. Let's, for example, pretend that the market had just barely got to this point. Let's pretend that this is right now. So what we're seeing here is that the end of a trend. The market has been below the moving average for an extended period of time. There's a big move here. And then very quickly and very suddenly, it moved back to the average and just started moving a little bit sideways again. And as of right now, the market's going down a little bit. So how can we use this information? Well, if we've been trading currencies for a while, maybe we will have a system that we can use to range trade or to trade the consolidation period. Because we know that the price is close to the average, and it doesn't look like it's really strongly moving in any direction, we can make the decision that we want to use a range trading strategy instead of a trend trading strategy. Or if we were to pretend that the market is, just right here, we very quickly reached the average, we've hung out around it for a while, and then broken strongly above it. This could be the very earliest indication of an uptrend, that an uptrend is forming. And maybe now that we have this data and we can use our moving average, we'll know we should use a trending strategy. Or if we strongly believe that the euro will rise in price against the dollar, then this might be our trigger point because we know that we've just gone above average, the price is above the average. So, to get in now might be the start of an uptrend. Now, of course, with the benefit of hindsight, that didn't play out. But that's the way that you would use a moving average. It can really be used to tell what the market is doing right now, what market conditions we're in, and that can be used to inform your other trading decisions. Now, we can also use a moving average just on its own to develop a trading system or an expert advisor. And that's actually something I do cover in my class, How to Make Passive Income Trading Forex. One of my trading systems is based almost exclusively on a single moving average. And in that class, I explain how that works. I explain how well that system has performed. So if that's something you're interested in, head on over to that class. But broadly speaking, the things to know about moving averages are you want to use a larger set of data. I'm going to actually change this to show you what it would look like if we were using a smaller set. By using a 10-period moving average, it doesn't really tell us anything. The price is always so close to the average that we don't know what we're doing. We don't know if we're in an uptrend. We don't know if we're in a downtrend. So we want to use a high number here, a large sample set of data. And then, the primary function of the average is just to tell us what is the condition of the market. Are we in an uptrend? Are we in a downtrend? If price is nearby to the average, then we're in a consolidation period. We're in a range. You can also use the average to define when uptrends and downtrends start. What you want to look for to do that is a very strong, fast move from one side of the average to the other. This is a perfect example. In this example, we see this is a fairly well-defined uptrend. You see a lot of space between the average and the price. But all of a sudden, right here in this candle, boom, price dropped from above to below the moving average. And the reason for this is actually having to do with some fundamental analysis. This is actually the date of a significant data release here that happened just right in the morning on the 3rd of July. But if we were looking at this in real time, this could be our indication both, of course, to close any long trades that we had and to get short, because this might be the start of a downtrend. Typically, when you see very powerful moves through the average, that can signal the start of a trend. This would be another example. The price was below and very quickly broke above the trend, and that could have been an example or maybe even an indication that a new trend was forming. So I hope that this lecture has been helpful for you. There are a lot of different theories, a lot of different ways people use moving averages, but this is how I like to use them. If you are interested in learning more about how we can just take an average and automate that to trade the market for us, head on over to my other class, How to Make Passive Income Trading Forex. In our next lecture, we're going to talk about Bollinger Bands, which are another very popular, very common indicator that form the backbone of many other indicators available in the market.